Let's start with our cash flow statement. Firstly, where does cash flow fit into our accounting procedures and in accounting? So it's also one of the statements. You started with your income statement and your balance sheet in grade 10 and grade 11. And now in grade 12, because we're working with companies, we also have to do a cash flow statement. So you are wondering, or you will be wondering, why do we do a cash flow statement? So, say for instance, the business is making a profit and you calculate that on your income statement, you might see that your bank is in an overdraft. Now thinking you are making a profit, but your bank is in an overdraft, how did this happen? So that is why we have a cash flow statement, so that we can see where did the money go and what or how much money came in. So we are going to go to our slides. You guys are going to go to your information booklet, and there we will start with our first page, page 3. So a cash flow statement reflects on the effects of the business activities on the cash resources in terms of how cash was generated, so money that comes into the business, and how cash was utilized, money that goes out of the business. So cash flow statement only focuses on cash, cash that comes in and cash that goes out. If you go to your next part, it says the business or the cash flow is divided into 3 main activities. So the first one is our operating activities. The operating activities you will see is the main income earning activities of the company, and this is their day-to-day business, how they get their money. So they get their money by buying products and then selling those products, and this is what we focus on here. How much money did they spend on buying stock, trading stock? How much money did they get in from selling that trading stock? And then also, how much money did they pay to creditors when buying that trading stock, and how much money did they maybe receive from the debtors if they sold that trading stock on credit? The second part that we will be looking at, or the second activity, is investing activities. So with the money or the cash that you have, where do you then invest this money? So the company will invest in fixed assets, and then if they have a lot of cash that they are not utilizing properly, they can put that in a fixed deposit. The third part, or the third activity, is financing activities, and that is activities involving the funding of the infrastructure of the company. So how does the company finance their business? They use loans, and then they can also have shares or capital. So they can either buy shares back from people, which will be an outflow of cash, or they can sell shares, and that would be an inflow of cash to the business. So the format of the cash flow statement is very important part of the cash flow statement. You need to know that format. So in your NSC exams, you will see that it can either be tested as a complete cash flow statement, full cash flow statement where you have to be able to calculate every amount in the cash flow statement, or it can be tested per activity where they only ask you to calculate certain parts of the operating activities, certain parts of the investing activities, or the net change in cash and cash equivalents. So this cash flow statement is a new statement, and because it's new, it will definitely be part of the examinable information that you need to know for the end of the year. So it's very important that you know the format of this cash flow statement very well as what goes underneath each activity. So let's start with activity 1. So the first part of activity 1 says you are provided with information related to Doonside Limited, a public company, for the financial year ended 29th of February 2024. The first thing you are required to do is to prepare a retained income note. So you guys will know that your retained income note and your share capital note are 2 of the new notes for a company that will definitely be tested in an exam or at the end of the year. So it's very important that you know exactly how to complete a retained income note. So let's start with that. So first of all, with the retained income note, there will be missing figures and missing amounts that you need to be able to identify. So you need to know the layout of that retained income note. So firstly, you need to fill in all the missing information in your retained income note. And for you to do that, you must be able to know what goes into the retained income note. So net profit after tax, very important. We use after tax and not net profit before tax. So you must know which one goes into your retained income note. Then, if the company decided to repurchase shares or buy back shares, that also goes in there. Then we have our dividends. Our dividends is split into an interim dividend, a final dividend, and then at the end we will have our balance at the end of the year for our retained income note. Now you guys need to go to the information on page 6 so that we can first calculate the net profit after tax. So the first part that we have to complete is the net profit after tax, and for us to do that we have to take the net profit before tax and the income tax. So that is the information given to us on page 6 from the extract from the statement of comprehensive income, and on that page you will need to use the net profit before tax and the income tax that is given to you. So those two amounts, we then subtract the income tax from the net profit before tax, and that then gives us the amount of 593,250, which is then our net profit after tax. Then the next thing that you will need to be able to calculate is your shares repurchased. Now for the shares repurchased, you need to go to page 7 for the information on page 7 regarding the share capital, and there you will see that they give you information regarding the share capital, which will be used to identify the amounts for the shares repurchased. So on page 7, if you look at the shares capital note, they have some question marks, and then there's also information that you have to complete using the information given. So first of all, we are going to look at the extract from the statement of comprehension of statement of financial position. There they give us the ordinary share equity, and they give us the beginning amount as well as the end amount. So to calculate the first question mark there, we have to fill in the beginning of the year's ordinary share capital as well as the end of the year share capital that is given to us. So here we can use the end of the year, and we put this at the bottom of our share capital note. So that goes to the bottom. This you will need to calculate. The average share price. So once you have the average share price, you will be able to identify how much money did the shareholders take from the share capital and how much money did they then take from the retained income. So if we quickly go back, you use your end of year to get the end of year total, and that you will then need to calculate the average share price. Okay, so let's quickly look at how are we going to calculate the average share price. So average share price is calculated by taking the total share capital value and you divide it through the number of shares at the end of the year. So you take the 2 million, the value of the shares, and you divide it by the number of shares, which is 416,700. That then gives us an average share price of R5.65, which means the shares were repurchased on the 1st of December 2023 to a total value of 22,400, and it was processed in favor of the relevant shareholders. We want to know how much of that 22,400 is share capital and how much is then part of the retained income note. Okay, so now we can calculate that of the 3,500 shares that was bought back, if you calculate R5.65 for the average share price, a total of 19,775 was then the part for the share capital note, which means if you then subtract the 22,400 or the 19,775 from the 22,400, you will then be left with the amount for the retained income that we need for the note. So 22,400 minus the share capital part of 19,775, and that gives us a total amount of 2,625. So there's two ways of calculating this amount of 2,625. You can either use the full 22,400 and divide the 19,775, and that gives us 2,625, or you can work back and see of the 22,400, what was the share price per, what was the total value per share that they bought back, and it was bought back at a total of R6.40, and then if you subtract the average share price of R5.65 from the R6.40, that gives us a pot of 75 cents that was then above the share price, and that is then the retained income note part. So let's go put that in our retained income note. So in our retained income note, we bought 3,500 shares back at a total value of 75 cents, and that is then a total of 2,625 for the shares bought back. Remember that shares that's bought back will be between brackets because it's money that went out of the business. The next information that we need to now complete is our dividends. So the final dividend is given to you. You now need to look at how to find the interim dividend. So there we go back to the information on page 7. Information E, and then also we can use the share capital. So here you find that interim dividends of 40 cents per share was declared and paid on all shares in issue on the 1st of September 2023. Now those are very important information that was highlighted. We are looking for the interim dividend. The interim dividend is 40 cents per share, so we know how much we need to multiply the amount or the number of shares with, but how do we calculate the number of shares that we have to multiply with the 40 cents? So that is why the date is then also very important. So the date is on the 1st of September 2023, and now you need to go look at your share capital. So your share capital tells us shares in issue on the 1st of March 2023 was a figure that we did not calculate yet. So we can first calculate that figure by working back. So we work from the bottom upwards, which means all the signs change. So if we start at the bottom to the 416,700, we work back, we add the 3,500 shares that was bought back, we subtract the 200,000 that was issued during the year, and then we get the amount of 220,200 shares that was issued on the 1st of March 2023. We now can go and look, where does the 1st of September fit in to our financial year? So on the 1st of March, we had 220,200 shares. On the 1st of April, we bought 200,000 shares. Then on the 1st of December, we bought back 3,500 shares, which means on the 1st of September, we did not yet buy back the shares on the 1st of December. So that means on the 1st of September, we only had a total of 220,200 shares for the beginning of the year, plus the 200,000 shares that was bought in April. So the shares was only bought back in December, which means we only work with 220,200 shares, because that was the total number of shares on the 1st of September, which we then use to calculate the interim dividend. We then add those two together and we multiply that with the 40 cents to get the interim dividend for the year. So let's go back to our answer sheet. So in our answer sheet, we can now include the interim dividend. So the 420,200 shares multiply with the 40 cents. That gives us a total of 168,080. So remember, when you do this in your exams or in your test, that you must always show your calculations. So if you do not get the number of shares correct, you will always get the figure that you have to multiply it with, or the cents that you have to multiply it with, and then you still get your marks for your note. So write everything down, every single calculation that you do, write it down so that it is there, so that the teacher can know how did you get to your final answer. Okay, so now we have all the information that we need to complete the retained income note. So now you will see that your balance at the beginning of the year is a positive, as well as your net profit after tax is also a positive. That leaves us with our dividends. Now 2 dividends was paid out, one during the year, and the other one is declared and will be paid out at the beginning of next year, but it's still part of the dividends for this financial year. So you add those 2 together, which means you also paid out dividends of 301,424. That is also between brackets because it's also money that went out, and that leaves us with a balance at the end of the year for 675,241. So you take your balance at the beginning plus your net profit after tax minus your shares that was repurchased minus your dividends, and then you get your balance at the end of the year. Remember, the interim and final dividend was already calculated in the total for dividends, so you do not do anything with those 2 amounts. Okay, now we've done 1.1. Your retained income note is finished. That is still part of the work that you guys must know or must have done in class already. So now we're going to start with the first part of our cash flow statement. So the first calculation for our cash flow statement. So they ask us in 1.2.1 to calculate dividends paid. Now, dividends, you know, we have a final dividend as well as an interim dividend. So I just have a part of the retained income note for the dividends that we just calculated, and that is the information that we're going to use to calculate the dividends paid. Then we also have our shareholders for dividend, because remember, your final dividend has not yet been paid, and it is also your shareholders for dividends, which is still a liability for the business. So you still owe that at the end of the year. So there's 2 ways of calculating your dividend paid. So the first one is you take your dividends or your shareholders for dividends at the beginning of the year, because remember, that is your final dividend of last year that you declared but not yet have paid, which means in the next financial year you will be paying the one that you're still owing to your shareholders from the previous year. So the 52,525 was declared the previous year, and then it will be paid at the beginning of the next financial year. So if you remember correctly, our financial year ended on the 29th of February 2024, which means the beginning of the year one was the one that was declared on the 29th of February 2023, but will be paid during the financial year of February 2024. So first you will take the beginning of the year amount, and then because the interim dividend is always paid during the year, you will add the interim dividend. So that means the 52,525 beginning of the year final dividend that was declared last year but paid during this year, plus the 168,080, which is our interim dividend for this financial year. Now, most of the time, this will be the calculation that you use when calculating dividends paid. But what if they do not give you the interim dividend separate, but they only give you a total? Then there's another calculation that you can use. So you can go to the second calculation. That is, once again, you take your beginning of the year plus now you add the total dividend, which is the 301,424, and then you subtract the shareholders for dividends at the end of the year, which will give you the same amount of 220,605. So you took the beginning plus the 301,424, which is both the interim plus the final, and then you basically subtract the final again because you have not yet paid that amount. Now, a very important thing here is when you calculate dividends paid, the word paid means that money went out of the business. So cash went out when you paid, so it must always be between brackets. So if you calculate it in the cash flow statement, or if you calculate it separately as a different question, you always put brackets to be safe because it's an outflow of money. Now, your next one is to calculate taxation paid. Now, once again, if you look at that, taxation paid is also paid, which means the answer here will also have brackets at the end. So to calculate taxation paid, the information that you need is your income tax, that is the amount that we use from the statement of comprehensive income that is given to you, as well as your SARS income tax amount. Now remember, SARS income tax can either be an amount or a liability amount, which means that you paid less than what you were supposed to pay and you still have an amount outstanding for the financial year, or it can be a debit amount, which means it's an asset and you paid more than you were supposed to pay. So to calculate this, I'm going to give you two ways of calculating it. So the first one is calculating taxation paid. So if both beginning and end was credit, that means if beginning is credit, it's still owed from last year and it will be paid during this year. Then you add the beginning of the year that you pay during this year, plus your income tax, minus your end amount. The reason you minus your end amount is because, remember, if it's credit, it means that you have not yet paid that portion of your income tax and it's still owing to SARS, and we subtract that because it was not yet paid. Then the other option is if your taxation paid is a debit, which means you paid more than what you were supposed to pay. So if that at the beginning was a debit amount, it means that you paid last year already, so you're not going to pay that same amount this year, so we deduct it from the amount that would be paid this year, plus your income tax amount. And then if your end of year is debit, it means that you paid more than your income tax amount, and that was also paid during this year, so we also add it to the amount that was paid. Now let's quickly look at what was the amount at the beginning, if it was credit or debit, and what was the amount at the end, was it debit or credit. So using those bubbles at the top by calculating taxation paid, you will see that your beginning amount was credit. Now if we look there at the first one, if beginning is credit, it means that it will be a positive amount. So we put the 7,750 as a positive amount. Then we add our income tax amount. Income tax is equal to 253,290. You add that amount, and then if we look at the end of the amount of the year, you will see that that amount was debit, which means you paid 7,500 more than your income tax of 253,290, and that means that this now also will be added to your amount. So you also add the 7,500 that you paid more than you were supposed to pay, and that gives us a total of 268,540 for your total tax that you paid during the year. Now there's also another way of calculating this, so we're going to quickly go to our whiteboard, and then I'm going to show you the other way of calculating your taxation paid. Okay, now you guys will remember that you all did ledger accounts for SARS income tax. So SARS income tax can either be a debit or a credit amount. Okay, now using this, you can calculate the amount paid in a different way by using the ledger account. So here I'm going to show you which amounts we're going to use, and then also which calculation we are going to then use. Okay, so first of all, you need to know beginning of the year and end of the year. So at the beginning of the year, we had a credit amount for SARS income tax. Okay, so a credit amount means that you put your balance on the credit side, balance brought down, and that is a credit amount of 7,750. Okay, now your next amount that you are looking for is your income tax amount. So income tax is 253,250, and that always comes on the credit side. So that's income tax, and that amount is then equal to 253,290. Okay, now you have all the information you need, and now on this side you have a bank amount that you need to calculate. So this bank amount on this side will be the total amount that you have paid to tax during the year. So by doing this, we now need the end of the year balance, and then the end of the year balance will give us the total that will then be paid during the year. So here, end of the year was a debit amount of 7,500, which means if we have a total year, you will see that we have a debit balance brought down of 7,500, and this amount came from there, 7,500. So this was your balance there, and then if you add all of this, you will see that it gives us a total of 268,540. That you take the other side, 268,540, and by doing this you will see that the total for bank was also equal to 268,540. So all the information given to us you can use to calculate your outstanding bank amount, and whatever balance you get here will always be the amount that you paid for bank or for income tax. Okay, so your balance at the beginning of the year was credit, your balance at the end of the year was debit, you fill that in, income tax is always on the credit side, and then you just balance to your bank account. Okay, so that is the other way of doing your taxation paid. Now let's go back to our slides. Okay, so now the next one that you have to do is 1.3.1. So 1.3.1 is where we have to calculate the cash flow from investing activities. Now, investing activities is your fixed assets and also your fixed deposit or your financial asset. So there the financial asset was already entered, a positive 20,000. So we now have to calculate our fixed assets purchased and our sale of any fixed assets that we sold during the year. So for fixed assets, the information D says fixed assets were sold for 100,000 cash at carrying value. Now for this, you can add that 100,000 as is in your cash flow from investing activities. So that 100,000 then goes straight to sale of fixed assets. Remember, when we sell something, money will come into the business, so that's an inflow, so we don't use brackets for that one. Then the next one is then fixed assets purchased. Now for us to calculate fixed assets purchase, it's very important that you know the layout of your fixed asset note. So you guys will remember that with a fixed asset note, we have our balance or our carrying value at the beginning of the year, which is your cost price minus your accumulated depreciation. And then during the year, there's certain things that can happen. So during the year, you can either purchase a fixed asset or you can sell a fixed asset. And then we also have depreciation that goes off during the year. And then at the end of the year, we once again have a carrying value at the end of the year, which is calculated by using our cost price minus our accumulated depreciation. So by knowing the layout of your fixed asset note, it will be easy for us to now calculate the fixed assets purchased. Okay, so let's go look at the information given to you. So there on top, I showed you that because you now have to calculate the land and buildings that were purchased during the year, you will start with your carrying value at the beginning of the year. So therefore, fixed or tangible assets at carrying value, they gave us 2,967,500, which is our carrying value during the year. And here I quickly just want to show you, you will see that I scratched out one of the zeros next to the fixed or tangible assets at carrying value. The reason for that is that there is an extra zero. You will see there's 4 digits at the end. It should only be 3 digits. So you can all just, from your information, you can all just draw a line through that extra zero. Otherwise, it's going to influence our final answer for fixed assets purchased. So we can just draw a line through that, and then we're going to only use 3,440,885. Okay, so let's quickly continue. So carrying value beginning of the year is then the 2,967,500. That then goes to your carrying value beginning of the year. Then minus any fixed assets sold. So there you will see the amount that you sold for fixed assets was 100,000. So you also take the 100,000 and you subtract it from the carrying value. Then you also have to subtract depreciation. Depreciation is also given to you from the extract from the statement of comprehensive income, and that depreciation you also subtract the 33,500. And then the last thing that you have to subtract is your carrying value at the end of the year. So carrying value at the end of the year is then your amount of 3,440,885, and by calculating all of this, you then get to an answer of 606,885, a negative figure, which then shows you the fixed assets purchased. So that amount of 606,885 is then the total value of the fixed assets that was purchased during the year. So that amount you then use to complete your cash flow from investing activities. So 2,967,500 fixed assets at carrying value at the beginning of the year, minus the 100,000 for the assets sold during the year, minus depreciation calculated during the year, minus your end of year for fixed assets, which gives us a negative amount of 606,885. Now, grade 12s, it's very important that you know this calculation to calculate either the fixed assets purchase or the sale of a fixed assets. Because if you look at all those figures there's 4 figures to calculate an amount, and that can give 5 marks to you if you know which amounts to use in your test or your exam. So it's very important. One of those will always be given. So either the sale or the purchased amount will be given, and then you need to complete the other one by calculating the missing figure. And if you know your fixed asset note, then it will be very easy for you to calculate the missing figure using the same principles, carrying value at the beginning of the year, and then during the year, if you sell something, you subtract it. If you bought something or purchased something, you add it, and then you always subtract your depreciation, and then you get that amount. Now, if you are asked to calculate the cash flow from investing activities either in a complete cash flow statement or in a block like this, it's always important that you also have the net effect of that cash flow from investing activities. So you will see those three amounts in the block. You now need to calculate what the total cash flow from investing activities for the year was. So you will see if you have a negative 606,885 plus the 100,000, that will give, plus the 20,000 of the change in financial assets, that will give us an outflow of money from investing activities. So now the business will also be able to see that the reason that they may have a negative amount at the end of the year in their bank account is because they purchased fixed assets. But fixed assets is an asset for the business, so it's a good thing that they then purchased assets or used the money in the business to purchase fixed assets. Okay. Then we are getting to our last question. So the last question is then our calculating the net change in cash and cash equivalents. So if we look at that, you will need the information once again in your statement of comprehensive income, your beginning and your end amounts. So there it's very important that you use your cash and cash equivalents as well as your bank overdraft. So for this, once again, we know beginning of the year and end of the year. It's always given to us like that. So there, first of all, for cash and cash equivalents, we have a 45,000 amount in our bank for cash and cash equivalents, and this can then be a savings account, it can be your cash float, it can be your petty cash. That's all the physical cash that the business has. And then with that, it is also possible for the bank to have, or for the business to have, a bank overdraft. So at the moment, for the beginning of the year, the business did not have a bank overdraft, so it's only the 45,000 rand that we have there. So for cash and cash equivalents at the beginning of the year, it is the 45,000 rand, and there's no bank overdraft, so we take the 45,000 rand as is. Then for the end of the year, we have cash and cash equivalents, which is once again your petty cash, your savings account, your cash float. That is an amount of 1,250. But now we see that the business also has a bank overdraft. So the bank overdraft amount is now equal to 47,500, which means there's a negative amount of 47,500 that we also have to take into consideration when calculating our cash and cash equivalents at the end of the year. So with this, I just quickly want to remind you that you must remember that when you calculate cash and cash equivalents, it's not only the cash and cash equivalents that you're going to use. You must please make sure that you don't have a bank overdraft. And remember, your cash and cash equivalents will be part of your assets, and your bank overdraft would be part of your liabilities. So it may be the case that those two won't be underneath one another. So you must always go and watch or look out for a bank overdraft in your question. Okay, so for the beginning of the year, we only had the 45,000, and then for the end of the year, it's the 1,250 positive cash and cash equivalents, but then our bank is in an overdraft, and overdraft is a negative amount, so we subtract the 47,500. So you will see that we have 1,250 minus the 47,500, which gives us a negative amount at the end of the year for cash and cash equivalents. Okay, now the next step is very important to calculate the net change in cash and cash equivalents. Okay, so the net change in cash and cash equivalents, you will see I made an end of, or the end balance. I draw lines for the end balance, and the reason why I did that is for me to show you that when you calculate the net change in cash and cash equivalents, you once again start at the bottom with your total and you work backwards with that, which means your signs change. So if you take the 46,250 negative amount and then you subtract the 45,000, you will get a negative amount of 91,250. So by working backwards, the sign change. So you always, the cash and cash equivalents at the end of the year, if it's negative, you start with the negative. If it's positive, you start with the positive. But when you work backwards from that amount, the sign of the beginning one will always change. So if it's a positive, you subtract it. If it's a negative, you add it, and then you get a negative 91,250. Now with this, it's nice because you will always know if you are correct by working downwards again. So if we work downwards again, we know we are correct because a negative 91,250 plus a positive 45,000 leaves the business, okay, there's a mistake there, leaves the business with a 46,250 at the end of the year. So that's just a mistake there at the end of the year. The end of the year should also be 46,250. Sorry about that. Okay, so 91,250 plus 45,000 also gives us a 46,250 negative amount at the end of the year. Okay, now we've went through all of this, but I quickly just want to come back to your quickly want to go back to the format of the cash flow statement. Okay, so let's quickly go back to the format of the cash flow statement. So here, very important with this, you will see that brackets in a cash flow statement means it's an outflow of cash. So outflow of cash, and then if there's no brackets, it means that it was an inflow of cash. And you must always remember that for cash flows from operating activities, you add everything that's not in brackets, you subtract everything that is in brackets, and that gives us the net effect which you put on the top of the amount. Then the same for cash flow from investing activities. If it has brackets, you subtract. If it does not have brackets, you add, and you always calculate the net effect, put it in the top for the cash flow from investing activities. Then we do exactly the same for the cash flow from financing activities. Now you will see that if you have your cash flow from operating activities plus your cash flow from investing activities plus or minus your cash flow from financing activities, it will give you the net change in cash and cash equivalents. So this amount A plus or minus this amount for B plus or minus the amount for C is then equal to D. So you will see that in our exercise that we had, we did not do a complete cash flow statement, so we did not use this method to get to the net change in cash and cash equivalents. We worked backwards from the bottom because the cash and cash equivalents at the end of the year was given, and then we got to that amount. So if you do if you do a complete cash flow statement, you can also see if your amounts are correct by taking A, or cash flow from operating activities, plus cash flow from investing activities, and plus or minus cash flow from financing activities, and that must be equal to your net change in cash and cash equivalents, because this is then the amount of money that you either spent during the year or the amount of money that you got in during the year. So you can use either this, or you can calculate it by saying the end of the year plus or minus the beginning, and then you also get the net change in cash and cash equivalents. Okay, so the last part, we are done with all of the questions, but I just want to quickly go back to your share capital note, and the reason for that is it is a very important note, so we can quickly complete it because we do still have time to complete that. So I'm going to quickly complete the share capital note that we have. So remember, for the share capital note, we already calculated the missing figure at the beginning of the year, shares issued on the 1st of March 2023. Then we add the additional shares, we subtract the number of shares that was repurchased, and that gave us a total shares that were in issue at the end of the financial year. Remember that the reason that we can use the end of the year to calculate the average share price and not the what happened before that is because the last transaction in the books was the repurchase or the buyback of the shares, and that means that that must be at an average share price, and that average share price must then continue to the end of the year. So that is one of the things that the shareholders would expect from the business, that when the shares are repurchased, the part that they take from the share capital note is always the average share price, and with that average share price, that must remain the same at the end of the year. So when you have a share capital note that you have to calculate in an exam, you can always use the end of the year if the last transaction before the end of the year was the shares repurchased. Remember that if you have additional shares after you repurchase shares, it's not possible to use the average share price or to use the end of the year figures to calculate the average share price. So with this, we can quickly work back to what the missing figures or the missing totals was, and then you can also do that. Okay. So we have our 416,700 shares at the end of the year. That was a total value of 2,354,355. Then we also entered our 19,775, which is the amount that we used from the share capital to repurchase our 3,500 shares. Then if you look at your shares in issue at the beginning of the year, that 1,056,960 is also a figure that was given to you for the share capital. And then once again, you can work backwards by using a balancing figure. So you work from the bottom, you work backwards to the top. Just remember that shares that was repurchased is always subtracted, which means when we work backwards, we add back the 19,775, we subtract our figure for the beginning of the year, and that leaves us with 1,317,107, which was the total shares that we then issued during the year. So the other reason I'm also showing you this is because you must remember that cash flow from financing activities will be your shares that you buy back in your company, and then also the shares that you issue in the company. So when we have a cash flow statement, we've only done the dividends paid and the tax paid. We have not done the cash flow from financing activities. So if they ask you to complete the cash flow from financing activities, your information that you will use is then in the share capital note. So there, your additional shares that was issued, that 1,317,170 will then be the amount that you have for proceeds from issue of shares. That would be a positive amount in your cash flow statement. And then the 19,775 plus the 2,000 of the retained income amount, which means the total of 22,400 will then be the amount for the shares bought back during the year. So then you will take the 22,400 and not the 19,775, because the total amount that the business have spent on shares that they bought back was 22,400. So that is just to show you that there is still another part to your cash flow, and that is your cash flow from financing activities, and you will use the information in your share capital as well as the information in your retained income note to then complete that. Okay. So we can quickly go back to the main purpose of a cash flow statement. And then there, so remember, your main purpose of a cash flow statement, it reflects on the effects of the business activities, and that is how cash was generated and how cash was utilized, which means that's money that comes into the business, physical money that goes out of the business. Your main operating activities is your income earning activities of the company, and then your investing activities is your fixed assets that you bought as well as your fixed assets that you sold, and then also a fixed deposit. And your financing activities is then your loans, money that you borrowed from a bank, or money that you are paying off from the loan that you borrowed, and then also your capital. So even though we have today only done a part of the cash flow statement and not the complete cash flow statement, you must familiarize yourself with everything or every part of the cash flow statement, and not only the things that we've done today. So just to quickly revise on the cash flow statement, if we look at the format of the cash flow statement, there are certain things that you guys need to know. So you need to know that cash flow from operating activities, that is cash generated from operations, and you must also remember that that would then be a note that will be given to you. So there you will have to know the note from that, and that is money that came into the business from the normal operations of the business by selling, by buying. Then the interest that was paid, the dividends that was paid, the tax that was paid. So that is in our normal business of operating activities, how we got money in and how we spent money. And then the second part is your cash flow from investing activities. So investing activities is where does the business invest their money. So they either invest it in fixed assets, so either by buying fixed assets or selling fixed assets, money comes in or money goes out. And then also from investments. So for investments, if you put money away in a fixed deposit or in an investment, money would go out of the business. But if that fixed deposit matures, money then comes back into the business. And then the last one is cash flow from financing activities. So financing, how does the business finance, or how does the company get money to finance? They can either take out a loan. If they take out a loan, money will come into the business, so it's an inflow of cash. And if they start paying back their loan, money goes out of the business. And then also with financing activities, you will have shares. That's your capital. You can either buy back shares, so then you would use money would go out, or you would then money comes back, or you can issue shares, and that is then for money that will come into your business. And that is then the bigger picture of how you got to either a positive bank balance at the end of the year, or then a negative bank balance at the end of the year. So if your bank is in an overdraft, this is a good picture of why is it in an overdraft. If it's not in an overdraft, if it's positive, maybe you can use some of that money to invest in something, and then you would also know where you can invest the next year or the money that you have in your bank account. Okay, that is it. I hope that you enjoyed this, and I hope that it helps you for the coming weeks for your cash flow statement, when you either start with your cash flow statement or when you write a test on the cash flow statement. Thank you, grade 12s.